appreciate you being with us, and also want to acknowledge that the last time we were together, I don't know, was it about 6, 7, 8 months ago, Peter?
It hasn't been that long. I think it was back in May or June.
Okay, so we are talking a long time ago, and I remember talking about that there could be a correction in the market, and
Right.
you said that there could be. You hoped that there would be, and that it was going to be something that you were going to back up the truck and load up on stocks, because you're one of the Super Bowls that I talked to. I've talked to a few others, but you're one of the first Super Bowls that I've interviewed in LAR. So tell me, here's the $1 million question. Is the correction over? Is it? I know we're well above the September, August lows. Could there be one more trip down, or are we on our way to your super high objectives that you talked about back in May?
I think we're entering a period similar to 2012 where there'll be a few minor corrections until the market regains its footing, find its balance. Because right now, if you look at various different things like the transports, for example, they're not confirming.
Okay, a little
But,
Dow theory thrown in there, huh?
right, but in 2012, they didn't confirm. But what they did in 2012 is they consolidated. They built a coil, and in 2013 they just exploded out of that coil, and that's why we had the so-called BTFD year in 2013. Some people call it an anomaly. I don't think so. It was what the market does during third waves. It was a third wave, and it was a year during which some cycle traders were calling for a top in the market, and the exact opposite is what happened.
Okay, so you see this as a similar setup to 2012 then?
Right. For the next few months, I think, until people get a feel for what's going to happen once the tightening takes place, the first rate hike. And
Is it going to happen? Is it going to happen in a couple of weeks, Peter?
I'm pretty sure it's going to. I mean, I feel that it's going to. I can share some charts with you and tell you why I feel that way.
That'd be great. You know
Let's
how to
see.
do it? You go up to that green box with the arrow, screen share, and you click that. It's on the upper left-hand side.
Right.
You
Yep.
click that, and then it'll some desktop will come up, and you click that and start. There we go.
And let me see if you can see my screens right here. Do you see my first chart? The
Not
stocks
yet.
index.
I
Not
still
yet.
see. I still see you.
Okay, let me see.
So you click the screen share, then you click on the chart you want to show, and then there's a start.
Oh, okay, hold on.
Goldie, that's 2 in a row.
Here we go. How's that?
Beautiful.
Okay, so that's the SOX index, which I
Okay,
track very closely.
semiconductors, since we're currency guys, that's technology stocks.
Right. So I use the SOX as a guiding light, if you will. And notice what happened during the 2002-2007 rally. The market rallied back to its all-time highs, but look well, at least the S&P did. The semiconductor index, it consolidated in a triangle. And then during the financial crisis, it dealt us the last leg down in this bear market. And then from here, we began the ascent towards the all-time highs. Eventually, we're going to get back to the all-time highs and exceed them. In 2011, prior to the summer 2011 swoon, the SOX index ran into resistance, the BD line of this triangle, and then began to decline while the indices kept rallying into early summer. And then what happened? The string snapped, and we had the summer 2011 swoon because we had that bearish divergence among indices. And then the SOX finally here in 2013 broke through this line, came down in October 2014, tested it,
Ebola crisis.
Exactly.
Yeah.
Then we rallied back up.
Right.
Printed the Mark 13 right here, a couple of them.
Right.
And then what happened here this summer, we came back down and tested the BD line. And that kind of told me, so everybody was looking for the S&P to test the October lows. It didn't quite get there. It was like 30, 40 points away from, and I'll show you why. But the SOX is the one that hit it right on the head. And now it's rallying again.
All right, I have one. Can I make one comment on it? Does it bother you at all that the S&Ps are a day away from new all-time highs, and
no,
the SOX looks like about 61.8 back during that same recovery process?
Exactly. So it's as easy as this. Tonight, Avigo will report. It might jump 10% and carries everything up with it. So, these things, they don't move in lockstep. They find their balance. They 2 steps forward, 1 step backwards. Eventually, they find their balance. But the 2 indices are different. This one is an index of 30 stocks. The other one is an index of 500 large cap stocks. They're weighted. They don't really move together. They're different beasts, Okay. But if you look at the SOX versus SOX SPX ratio, and that is something that I track myself. I'm always looking for whether the SOX is outperforming the S&P, yes or no. And if you look here, we've had outperformance mainly since the summer low, and this week the SOX is certainly outperforming the S&P, running into a little bit of moving average resistance here, but eventually it's going to break through it. Notice in the summer, here's what happened, by the way, in 2012. We formed an...
So in the summer it was outperforming during the distribution phase by a lot,
What happened is in 2012, 2013, until Apple bottomed in 2013, by then we had formed an inverse head and shoulders on the ratio, the SOX SPX ratio, and then the so-called BTFD period began. By the summer, the SOX had already caught up with the S&P from a performance standpoint because it was lagging all along. When the SOX SPX ratio reached its prior high, which was set in 2011, that's when the correction began. But you can see that there's a massive base right here, and there's a potential for us to break through this and continue on to higher highs. So that's the SOX SPX. So again, this guy's going to have to regain its footing as well. All I see here is a V-shaped recovery, which I don't believe much in. I like things to form base from where to break out.
You want to know what I see? Probably won't matter to you. But the low in October and then the low that we had in the fall, to me, is an incomplete formation. You have 2 drives. I think there could be one more.
There could be.
And maybe even take it to your blue dotted line.
Right. You know what? Yeah, I was hoping it would get all the way down here. It did not, but there's strong support here. If you see that black dotted line.
Yeah.
So. If you move on to the S&P, and also that's gold, we'll talk about. Well, we can talk about gold here. That chart goes back to March, and I said we're heading down to below 100. We're flirting with 100 right now, I think, somewhere along these lines. But gold is going to continue on down, and I think it'll get to about $800 before it reverses course.
Okay, interesting. Go ahead.
This is the bank index, the NASDAQ banking index, which I track as well. You can see that at the dawn of the financial crisis, the banking index had completed a 5-wave rally, and then we came back down. We crashed into the low of wave 4, and then we began the ascent again. Now we're flirting with resistance right here. The top of the B wave and the median line of the fork. But I think we have, at a minimum, to reach the 88.6% retracement, given that wave 1 was at the 38.2. If we break through that 88.6% eventually, we're going to go much higher. We're going to go to the 1.618 extension of this correction, so much higher. But right now, this is an area of resistance right here.
So the financials would welcome a lift off of rates.
Right.
Isn't that part of it? But what about the problem, Peter, that everyone, you know, the markets in some ways, short-term rates have priced in a Fed rate hike, but the yield curve, instead of steepening, is flattening. Does that mean anything to you?
You know, it can be interpreted different ways. You know, I'm sort of on a neutral line with regards to that. You know, it's whatever the market wants to assume. You know, things can change in a heartbeat. So if the economy strengthens and earnings reaccelerate, then all that will be in the rear mirror. You know, but I think with the dollar strengthening and gold falling, where are you going to put money? You know,
I just want to push back a little bit on the gold, and I see how we could get there. In fact, 880 was the high in 1980. It was a 20-year high that lasted, was on the Russian invasion of Afghanistan. But I was taught this, that the shares normally bottom before the underlying commodity when it comes to commodity stocks. And gold's made successive low after low after low. And you could find a lot of miners, Peter, that are not confirming this break in gold. What do you make out of that?
You know, I have a chart of the gold miners that I published in 2012 calling for I think the GDX or GDXJ, I forgot which one, to go all the way down to 12 bucks. And I think it got to 16.
1250. 1250, I think is the low.
Right. So I don't know much about gold, but here's my theory, is that when the Fed launched their quantitative easing, the first QE, it was around 2008, if I recall. And then gold took off from there. It was right around 700 back then or so. And so the assumption was that all this money printing is going to lead to
hyperinflation.
Hyperinflation. Well, we don't even have inflation right now, you know.
Yeah, we have disinflation to deflation.
Exactly. So all that assumption, we're resetting now. We're going back to that level, and that's what my chart is telling me, is that on the heels of this triangle, there's one more leg down to that 70 area, okay? And you can see this is a corrective, this is a double zigzag taking place here. ABC was the first zigzag. This is where Peter Schiff loved the chart right here on top, at the top of that X wave, and then from there on it was nothing but downside.
So you're a big Peter Schiff fan too?
No, I can't listen to the guy, man.
I have a fan facetious.
Yeah, I know.
Okay.
And
so do you have any type of time window where you think that WC5 might complete?
No, I really don't. I don't do much with time projections, to be honest with you.
Okay. That's fine. So then, if you're looking for this, do you take any of the dollar's movements into consideration in your equity trading? Dollar.
I look at the dollar and I see the dollar strengthening. So I think because employment as an all-time low right now, eventually this is going to translate into spending. Spending means economy is improving. Hopefully, that's the assumption. Stocks are moving higher. The dollar is moving higher. Those are good economic signs. You know, they're not moving in inversely to each other. So those are good signs to me. Okay, that's why I think maybe this time around the treasuries market will eventually be wrong and the stock market will be right.
So we'll have a rising, a bear market in bonds and a bull market in equities.
Yeah.
And your wave 3 target looks like what, 2561?
On the S&P? Oh yeah, here's the S&P. So we were talking about why the S&P never quite got all the way down to its October low. And the simple technical solution is this pitchfork. This pitchfork, if you base it right here at the bottom at the 2010 flash crash, and you anchor it at the top of the 2011, the 2011 top, and then that was what? That was the 2011 summer swoon. So if you draw the pitchfork that way, you can see how we flirted with the high, with the top of the channel, and then we crashed into the bottom of the channel. That itself contained the decline, never allowed it to quite get all the way down to the 1818 low of October 2014. And then here, this chart, by the way, I think I did this chart 3 weeks ago when we were first scheduled to have this interview. And we ran into the median line, and then we began correcting. And then what happened? The Paris event, the terrorist event. And then we gained our footing, and as of this morning, we're flirting with this line again. We're trying to break above it.
Above the middle of the pitchfork.
Right, right. But eventually it's going to be 2 steps forward, 1 step backward. It's going to be a choppy ascent towards 2561. It's not going to be as momentous as this wave. We're going to see a less momentous rise towards the target. So my target is about roughly 2,500. From there, I see a major correction twice as severe as the one that we saw this summer. That is going to retest the lows before eventually turning back up and head towards 3,000 plus.
Okay. All right. Nice. Yeah. Anything else you want to share with us today, buddy?
Same thing with the ComQ, the NASDAQ composite. I drew the similar pitchfork. We hit the bottom of the pitchfork here, flirted with the October lows, and now I'm seeing anywhere from 62 to 6,700 as the next target. Eventually, if you look at the big picture of the NASDAQ composite, it formed a massive cup, and we exceeded the highs of 2,000. Now we're on our way, and this correction right here, which by the way, even it's possible that the correction ended, or the nominal low, the correction is in place, but in terms of time, we could still see some gyrations, some sideways movement before we eventually break. But last time we talked about this very chart in the last interview. I said this fourth wave, which will backtest the yellow pitchfork, and that's exactly what happened right here. It will form a handle. It'll form a handle, and then once that handle is complete, we're going to break out of the cup towards the wave 5 target. But normally, what happens, and we see that all the time on smaller time frames, once you break out, you're going to have to come back and backtest the rim of the cup. And that would be the yellow wave 4. Once wave 4 is in place, we continue on rallying towards the 7,000, 7,600 to complete this 5-wave rally. And from a harmonic standpoint, we have a bearish crab pattern, XABCD. Once we get to this area right here, I'm expecting a violent reversal that will come back down again and retest those lows before continuing on higher towards the measured move of this cup. Because remember, this is a wave one right here. That this AB segment, we haven't talked about it. This AB segment is wave one, and what's happening at the largest degree of trend is wave three. So we're still in wave three of the largest degree, and within wave three, we're going to see minor corrections, relatively speaking. They look severe, of course, but from the degree of the trend, the trend degree that we're talking about here, this would be wave 1, 2, 3. 3 will end here, 4, and then 5 towards 10,000. Of course, that
okay,
will.
so we're in the sweet spot. Wave 3 is the money wave, isn't it? Because it's usually some type of fib extension of 1, right?
Well, not if you're trading every hour and every minute. If you put your money in the market, let's say you put them, you went in this August at the August low, and then you took a trip several months or a couple of years, then you'd come back, you'll probably be rewarded. But if you're trading day in, day out, week in, week out, you know, you're going to have to withstand all these crazy moves. So
okay, Peter.
That's my view.
Okay, it hasn't changed. I hope you were able to back up the truck. It was not easy to buy that 1,000-point lower opening that day.
No, I did not do it.
All I did was cover shorts that day, and then I thought we were going to have a failing rally to 2050. So here we are knocking at the door of new highs. Why don't you tell us a little? Why don't you tell? Go ahead.
I did not do it. I did not back up the truck because at the end of September, I said there was a falling wedge that I thought was a counter trend rally ahead of another leg up in what I thought is a counter trend rally before the final low will come in. So I traded that rally from the end of September, I believe. It was a Friday, and I said, that's it. We're going to rally right here in a big way. And then I had a particular level beyond which the NASDAQ shouldn't go. If it were to be exceeded, then I would conclude that the correction is over. And then by then, you know, when it proved me wrong that the correction was indeed over, that we're not going to see another low, it was too late to back up the truck. So I'm doing what I do, what I do all the time. Now, if I get another entry point and I decide to do it, I might do it. But I prefer to continue doing what I do, which is trade what I see, sell credit or sell premium on a weekly basis, and just.
Okay, so you're an option writer too. So that's a great segue into describing what you do at WWW 61.8. Why don't you tell us a little bit about your service?
Well, with my service, what I do is I try to pass on the information that I see in an actionable form, so that other people can learn from my charts and understand why I'm trading a particular instrument, what the setup is, learn about chart patterns, various different things like this. So it keeps me in line, keeps me disciplined, because more or less I'm accountable to others. You know, I cannot lose discipline. So that's basically what I do is I trade the chart setups that are in front of me, and I offer my view of the market. Now, of course, that's more of a segue to what I eventually am planning on doing, which is release some software that automates a lot of the things that I do. And I call it a search opportunity trade engine. It's a piece of software that automatically, based on the criteria that I use, it automatically identifies trade setups and publishes them for us to take advantage of. So,
well, Peter, it's my hope that your cup, like on the chart, runneth over during this holiday season, and that you have another opportunity to back up the truck. I'd like to see just one more retest and flush out the lows. You know, anything's possible. I'm still in the camp that that 1800 level could be taken out one more time
You know, you're not the
before.
only one.
I
You're
know I'm
not
not.
the, yeah, yeah, and you know it's possible. It's very possible. We'll see what
Yeah,
happens. We'll see how the
yeah,
market will react to this rate hike.
yeah. But then I think that you could be right, and that maybe what we do is maybe we correct into the April time frame everything. You know, if you're right
Mhm.
about the gold, deflation isn't healthy. The too strong of a dollar might be a problem. All the oil debt that's out there into April, and maybe we just have a period of grinding into taking out those lows one more time, and then maybe the Fed thinks twice about their tightening program
Mhm.
and
Mhm.
joins the rest of the world for global QE again.
Right. Right. So you know, good luck.
Yeah, good
That's all
luck.
I can say. You know.
Good hunting. You know, it's not about luck anymore, is it?
And no, and that's exactly why the backing up the truck isn't my style. I just
Yeah.
want to. The market is so dynamic, and I prefer to just be able to change, to you know, change stance at a moment's notice. I just don't want to commit money and just watch it take these round trips. Just you know, take what the market is willing to give you and move on.
Yeah,
So
I can't back up a truck either, Peter. I have a Ford Pinto. I'll have to open the hatchback at the appropriate time. So,
right.
um, uh, Merry Christmas to you, buddy. Happy New Year, and
Merry Christmas, Happy New Year to all.